Hi, I'm Tom Lydon, editor of ETF Trends here in Chicago at the Morningstar ETF Conference. And I'm here with Mike Eschmann, who's Managing Director of Capital Markets and Institutional Strategist at Direxion Investments. Mike, great seeing you.
Tom, good to be here. Thanks for having me.
So as we're into the fourth quarter of 2015, a lot of advisors are positioning their portfolios to maybe take advantages of the volatility and some sell-offs.
Sure.
And with that, you've got a tool that's quite unique in the fact that even though you guys were built your business on inverse and leverage, you've got a kind of a unique leverage product that is resonating well with advisors these days.
That's right, Tom. Yeah, we introduced the industry's first lightly leveraged ETFs. So it's sort of a way for investors to dip their toe into leverage type products. They carry a 1.25 beta, so you're getting just a little bit of added exposure to popular indexes such as the S&P, the Russell 2000, emerging markets, developed markets. It's a way for investors to get a little bit of extra exposure and maybe not suffer some of the issues with the triple and double leverage products. Don't have to be as tactically oriented as you do with those products, with these more lightly leveraged.
Right. Rebalancing isn't as severe, right? And you still have the tax efficiency to a great degree.
Yep, exactly.
And then from portfolio construction standpoint, especially as we get up to the end of the year, maintaining the portfolio balance, this is a great tool that I think you're finding some traction with.
We are, yeah. I mean, we've been having a lot of conversations with advisors who really can see the benefits of just a light bit of leverage. They may not be tactical investors, they may not have much experience with the leverage products, but they can see the benefit of using just a little bit of leverage, and it's a way for them to gain exposure to that and really not have to be active traders in doing it. That little bit of leverage, the products still work in much the same way as the double and triples from a structural standpoint, but the lower leverage point means that they don't have to be as tactically trading in and out, and it's a way to kind of get a little bit of boost with these products.
Well, you're speaking about inverse and leverage. There are more and more advisors that are utilizing these tools. I mean, they understand how they work. They do exactly what they're supposed to do when they're supposed to do it.
Right.
But now, as we're seeing, maybe a bull market a little bit long in the tooth, and the thought of higher interest rates and what that might do as far as a headwind, being a little bit more tactical is something that advisors are opening up to, would you say?
Absolutely, yeah. I mean, as the leverage and inverse products have matured, I think more and more advisors are adopting them, or at least see the benefit of using them in different markets. And as volatility picks up, and as you say, as the bull market gets a little bit long in the tooth, we're having a lot of conversations around hedging, both equity markets and a rise in interest rates, if that ever actually occurs.
Right.
One of these days. One of these years, it'll happen. But that's a conversation we have quite often with some of our inverse fixed income products.
Well, you guys do a great job of educating advisors, and as always, Mike, it's great seeing you.
Thanks.